Hey everyone, welcome to my webinar on passive investing in commercial real estate. I know your time is valuable and I plan to make it worth it. I've distilled all the lessons that I've learned over the past decade in investing in real estate into an action-packed deck here that I'll present on. For those of you that do not know me, my name is Stephen Quisenberry and I'm the co-founder and principal at Kamolo Capital, and I'm a real estate entrepreneur that left my W-2 job in 2024. Whether you are a new investor or an experienced investor, I'm hoping that you can get some good actionable insights from today's webinar. We'll go over and dive into specific strategies on assessing real estate deals. We'll talk about different topics that are really important and then some tools and strategies and questions that you can ask when evaluating a passive investment opportunity. Please stick around and make sure to watch till the very end for a special giveaway. I'll give some instructions on how to download those giveaways, but I have some PDFs, some spreadsheets for you to look through that I think will add a lot of value as well. Disclaimer. So we present disclaimers on all the information that we provide here. It's all educational and informational purposes only. Obviously, if you're making any investment decisions, please consult your legal, tax, and financial advisors. I'm not one of those advisors, so I strongly recommend you reach out to them if there's anything that you're investing in. And then obviously that, just that any investment decision that you make is solely your responsibility. All right, so let's start at the basics on what is passive investing. Passive investing is providing capital to a real estate deal where you are hands-off and not involved on the day-to-day operations. Generally speaking, in a lot of syndications, this is $50,000 minimum. Sometimes it can be higher. Most of the time, the reason why someone would want to do this is to generate some passive income, not have to worry about the day-to-day aspect of managing it, diversify your portfolio, and leverage some tax advantages. Active versus passive investing are two different things. So active investing is when you're investing in small multi or single family homes. And obviously the pros there is you have more control. The disadvantages there is there's more time commitment on the individual, and then there's scalability challenges. With passive investing, you have less time commitment, better operational advantages and scalable wealth building advantages, but you have a lack of control. So this just kind of outlines the pros and cons. There's advantages for either way you go. There's a lot of different ways to make money in real estate. These are the two kind of pitted against each other. Passive investing is typically for busy professionals that want to diversify out of the stock market or have alternative investments, but not be so hands-on that they're dealing with the property managers like you would with a single family. A few different options when it comes to passive investing and investing in real estate. You can invest in syndications, which is a group of investors pooling their money to buy a larger property. You can invest in a fund. A fund is a pooled investment vehicle that invests in multiple properties. So there may be a fund that says, hey, we're a multifamily value add fund and we're going to buy as many assets as we can this year with however much equity that we have. So they may buy 6 assets throughout the year. Obviously, this spreads out your concentration and diversifies your money. It also limits a little bit the upside because the gains are spread. So there's advantages and disadvantages with funds. And a REIT's a publicly traded investment company that allows for easy entry and exits, but obviously lacks the direct tax benefits of syndications and usually has a way less upside as well. Why multifamily and commercial real estate? So first off, stability and income reliability is off the charts in favor of multifamily. People need a place to live. There's an incredible housing shortage that's happened in the last decade in the United States. And then you have diversified income streams as well, reducing the impact of individual vacancies that you could experience with single family rentals. The second kind of pillar is the wealth building and growth potential. So every dollar, if you think about kind of a income statement, revenue minus expenses equals NOI, net operating income, every dollar that's added to the NOI, your property becomes more valuable. And so when you think about multifamily and commercial real estate, adding to the value of the property by increasing income or lowering expenses obviously creates an appreciation potential that's a little bit more in control versus a single family where your value is based on your neighbor. And then obviously there's tax and investment advantages. Investment advantages, we kind of touched on this in the earlier slide. There's professional management. There's often access to institutional grade deals that allow you to participate in really good investment opportunities that you otherwise wouldn't be able to participate in by yourself or take down by yourself. Tax advantages, there's a lot of different advantages that we'll go over deeper in another slide later in the presentation. All right, taking a big step back and looking at it from a high level point of view, what is the typical life cycle of an investment opportunity? So this is kind of 4 stages to think about, regardless of what asset class and how long your time horizon is. This is generally what's going on with commercial real estate. There's 4 different stages here. First, you got the acquisition stage where you're doing the underwriting, the due diligence, you're raising the capital, getting the financing, and then you take ownership of the property. The next stage is where you're adding some type of value. So this is what you identified in your underwriting. You identified this in the acquisition phase through all the deals that you looked at, that there's some advantage that you can take or some opportunity that you can take advantage of and implement into the business plan here. So you're adding, maybe you're renovating units, maybe you're decreasing expenses, maybe you're doing something different on the leasing side point of view. There's a lot of different things that this could be, but you're adding value to the property and increasing the NOI. So that's the goal in the value add stage. Next, you reach the stabilization phase. So you're achieving, after the value add stage, you're achieving your targets, optimizing, maybe fine tuning and prepping for that disposition phase where you evaluate the best timing based on the market. So I always like to think of it as you buy the property, your head's down working on it, making sure that, or working to improve it, get it better, operating better than the way it was before. Then you pick your head up and survey the market and kind of figure out the optimal time to either sell or refinance. All right, now we're on to how to evaluate a passive investment opportunity. So a big portion of the webinar here today is going to be spent on these two concepts. First, I like to think of the real estate investment opportunity as two different components. One is the jockey, one is the horse. The jockey is the sponsorship group or the operator of the deal. That is, to me, probably the most important component of this. Do they have industry experience? Do they have a track record? Do they communicate well? Are they transparent? How does their alignment of interest? All these factors are really, really critical in understanding who you're investing with, because frankly, there's so many different things that could go right or wrong in an investment opportunity, and you want to make sure that you're investing with someone that's going to fight when things get hard and someone that's going to have your best interest. So that's super important to make sure that you're aligned with that jockey. The horse is definitely a big component of the deal, and there's quite a few things that you can do on the side or understand, kind of go behind the sponsorship group and kind of analyze the deal yourself. So I'm going to walk through a few components of that are really important to understand. First, let's talk about the jockey. So the jockey, asking for their track record, understanding their communication skills, asking for reporting, example reporting. What does it look like to get communications from you? These are really important things. These are things that I learned after being an LP for a lot of investment deals. Some sponsors communicate a lot and are very transparent. Others do not. So you want to understand what kind of communication happens. Alignment of interest, understanding how much dollars that they're investing into a deal. General rule of thumb is 5% of the equity amount after fees, net of fees, after an acquisition fee as an example. Market expertise, understanding what experience level they have in a market, what kind of vendors, property managers they work with, how much expertise do they have. Those are all big components of understanding, and it kind of feeds into the operational competence. And then also risk management. You can identify this through some of the offering memorandums. Reputation and integrity can kind of be understood through multiple conversations or talking with previous investors. And then, so one thing that most people may not think of is social proof and public transparency. So if they have an online presence or a social media presence and they're kind of building in the spotlight, for example, that kind of gives an extra level of reputation risk that a sponsor may have. And some of the other items, 9 through 14, are fairly self-explanatory, but this is a good list of 14 items that you should really think about and understand for each jockey that you want to invest with. And I would recommend, having a few that you're interested in investing with that kind of fit this criteria, and just kind of keeping track on their list and seeing what opportunities they have with, how do they communicate those new opportunities, and then I'll give you a feel for what to expect going forward. Next is the real estate opportunity itself. So location is the fundamental pillar of real estate. Understanding what drives the market is very critical. So you can do some of these go behind the scene research items. You can type in population growth and compare it to national and state averages. I would look at income trends, population growth, and job creation. Those are like the three big things that are going to drive the economy in that particular local market. Obviously, you want to check out supply, vacancy, and then neighborhood quality. Business plan. How is their investment strategy? Have they done it before? What's their targeted timeline? Is it realistic? What's their underwriting assumptions? We'll go into that in more detail, but we want to see them expand their exit cap rate to be conservative and not assume that they're going to exit with a lower cap rate. That is not conservative. We want to see sensitivity analysis to stress test projections. And then going down to the next bullet here is alignment of interest. Do they have transparency in all their fees? Again, what is their total investment in the deal? And just understanding their waterfall structure would be immensely helpful. Obviously, the tax advantages and understanding what K1s to be expected. Definitely ask for when do they deliver their K1s. That's hugely, very, very important. All right, let's talk about common investment metrics. So these are pretty common terms that you need to be well versed on to understand what an opportunity, the benefits of it and what you can expect from a return perspective. So some investors will kind of key in on certain investment metrics over others. Cash on cash return is, very simply put, the annual cash flow that you receive as a percentage of the equity investment. So I have examples here of each of the different types of returns, and I encourage you to pause it and kind of read through these, make sure that you understand these. IRR is a simple calculation that has an annualized return over the whole period of every cash flow dollar that comes back into you, and so it's a common metric that's used to kind of understand unilaterally across multiple different investment opportunities what type of return that you can expect to receive over a whole period. So generally speaking, at Kambola Capital, we tend to look for opportunities depending on the risk and the type of asset. We're trying to look for 14 to 17% IRR on typical. Other opportunities may have a little bit higher, but they may be a little bit more risky. So in a development deal where there's no cash flow and a little bit higher risk, but may have more upside, there may be a 20 IRR as an example, but there's more risk associated to it. For debt or mezzanine debt or preferred equity, it may be closer to 9 to 13% IRR. and have less risk on that because they're higher in the capital stack. So those are some things to think about. Equity multiple is a very common one that's used. That's just simply the total return dollars divided by the equity investment amount. So if it's a 2x multiple, we doubled your money during that whole period. So a 200K return over a 100K investment would equal 2x multiple. Preferred return is often one that people get confused on. Preferred return is the minimum amount of return level that a sponsor is going to give a investor before they start splitting returns. So if that does not make sense, pause this video, listen to that a couple times. This is not cash distributions. That a lot of people get this confused with cash distributions, but I think of it, this example is pretty easy to follow. If there's an 8% pref return and there's a 5% cash flow per year, that remaining 3% is accrued and owed to the investor at the sale or refinance. So it's interest owed to an investor that accrues. I think that's the biggest misconception or most common misconception that there is on the returns. Average annual return is another way to look at IRR. Is just going to be usually higher than IRR. So I would stick with IRR usually. Tax benefits of passive investing. So you'll get depreciation and cost segregation done. Typically, these are studies that are front-loaded in year one, and so that allows you to front-load depreciation expense and give investors a higher passive loss in year one. That, obviously I'm not a tax professional, but that those losses can then be used to offset other passive income. So not your active income, but your other passive income. So where this works beautifully is when you have multiple passive investments that are spitting out income or going full cycle, and then you can roll it into the next deal to get passive losses to then offset those passive income gains that you had. So that's a big component of the tax game that a lot of investors take advantage of with the passive investing. 1031 is also a good advantage for passive investing and can be executed, although 1031 is pretty hard to execute realistically, and oftentimes you're kind of forced and rushed, but if there's a great opportunity, it's a great way to defer capital gains as well. The next topic is to understand the investor experience. So this is what the investor experience looks like for us at Convola Capital. We have monthly update communications, which is a monthly narrative on what updates are happening at the property, and then quarterly reporting. We do that each quarter, and we have financial reporting along with photos on any CapEx work that is being done, as well as operational KPIs that we're watching or want to share with investors as well. We do quarterly distributions. We make sure that K1s are delivered on time. So one big piece about passive investing is that you're going to get K1s from these investment entities. These K1s are usually delivered between March and April timeframe. So if you're used to filing your taxes as soon as you're able to in January, that will not be the case with a passive investment. And then understanding if you have a secure investor portal, these are really good things to have to transfer documents like K1 securely. So just other nice things to have, and you'll be able to log in to see your investment dashboard as well. All right, a little bit about us. So a little bit about my story, I guess, is I'm from Georgia, now live in North Atlanta suburbs with my wife and 3 kids. I was a former military officer, also did corporate sales, corporate leadership. I was an individual account executive as well. So a variety of different experiences in corporate America. I also did acquisitions for an institutional multifamily operator. So I worked with them both on the acquisitions, and I also did investor relations for them as well for a period of about 2 or 3 years. And then in 2024, I decided to go full-time into real estate. Along that whole timeline, I was investing in real estate. So whether it was single family investments or multifamily purchases, I also did multiple different types of CRE deals. So not just multifamily, but a variety of different commercial real estate that I've invested in. Our buy box typically is 20 to 25 units multifamily, and we're looking for a 1.8 equity multiple. So what that means is we're getting close to doubling your money if you remember our conversation in the common investment metrics. And we're looking in the Atlanta and DFW markets for opportunities. And these are just a few of the lessons we've learned and how we started. You're looking, if you're interested in being a GP, I'm happy to talk through and just kind of articulate more how we started and some of the things that you need to think of as you're moving along. But really excited about the potential and the opportunities that we've had. If you have questions, I'm happy to discuss further. The next steps is I'd recommend you download my giveaways. They'll build on the things that we discussed here. There was a lot of detail that I didn't include that would take me 30 minutes, 45 minutes to go through ad nauseum on this call. But those will be good information for you to continue what you're learning in your passive investment journey. Schedule time on my calendar. Happy to discuss any current or future or past opportunities that we've had as a group. And if you raise capital, please reach out about our partnership opportunities. So that's ways that I can further help. All right, now for the instructions on downloading my giveaways. So I've got PDFs and I've got spreadsheets that will be really good for you to look through. If you look in the description of the YouTube video, there will be a link there for a Google Drive box. If you click on that link, it'll take you to the Google Drive box, and you'll be able to download from there. So hopefully you got a lot of value out of this. I went through it pretty quickly, but there was a lot to go over. Again, here's my contact information. Looking forward to continuing the dialogue, and hopefully this helps you in any way. And best of luck on your journey. Thanks.